Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with the GDM. Welcome to our final webinar of this month. Today we will have a look at the currency strength and how we can measure it. Most importantly, this particular topic I've left for the end of the month because with this topic, ladies and gentlemen, we will summarize everything that we spoke so far and connect the dots. Now, basically, what we know so far is the key fundamental factors of the fundamental analysis. We also know how to make a fundamental analysis on Forex pairs, and we know how to make a fundamental analysis of commodities. But today's session is from technical perspective. For a given time period, we are going to measure the price movement, convert this into percentages, and of course, we will find out how to categorize different currencies and grade them according to those percentages that we found. It's not a very difficult process. However, the most important part here that you need to remember is that this currency measurement, currency strength measurement, you can do for any particular time frame. It doesn't matter if you are a long-term trader, like one-day chart, weekly chart, and so forth. Or you are a swing trader that you are actually holding positions for a few hours to a few days, and you're observing hourly charts to 4-hour charts. Of course, it doesn't matter if you are a short-term trader or a scalper as well. Today's focus will be pretty much on swing traders to short-term traders, basically because the thematics and the principle is one and the same for larger and smaller time frames. That's why we are going to focus on the intermediate level today. Most importantly, this in a combination with appropriate fundamental analysis, you can find out in short terms price fluctuations and directions, especially in terms of market pricing, and catching a better price is what we are actually all after. Now, if you are a buyer, of course, you would like to find the lowest price. If you are going to invest in certain currency pairs for a long-term period, for a couple of months, half a year, or maybe 1 year, you would like to find out where is the level from where the currency will actually start bouncing off. So you need to find out which one is stronger, which one is weaker for a particular time frame in order to assess the future price movement, and you can pair that up with other currencies in order to make the most efficient decision on the market. So along the way, what you see in front of you, ladies and gentlemen, is not the usual file that we are working on, that everything is ready and I'm just showing it to you. Today, one of those files, we will have it with a live data input. Basically, I've taken out from a few minutes ago, just before we started, on 6 major currency pairs. 6 major currency pairs, 7 major currency pairs, I'm sorry about that, 7 major currency pairs. I have taken out all the current prices, like from a few minutes ago. Of course, right now it's slightly different, but the principle is still the same when you analyze it, because you will like to analyze to a current price. So actually, in the next 10 to 15 minutes after your data is input into those tables that I'll show you later, will of course often change, but that's not the main problem of the assessing currency strength. But basically, because we're looking at from mid to long term time frames, and of course mid to long term price movement. Therefore, right now we will start with something to get you going on the particular topic today. The first thing is that we need to equalize the difference. You need to find out why we're actually doing this and what is the actual base of this particular measurement of currencies. This is very simply put, for example, is that when you want to, when a trader buys or sells a particular currency pair, they're actually simultaneously going long on one currency and short on another. So traders coming from other markets, for example, this concept may initially sound a little bit strange or probably difficult to find out why exactly that is. Basically, if you are someone that is actually trading indices or company shares on the physical market, those that we're actually dealing with pretty much every day, this is extremely important thing to remember, that when you're buying or selling a currency, you're automatically going long on one and short on another currency. So to equalize the difference is one of the difficulties that can arise when comparing currency pairs to each other. The fact that each pair has its own price structure. So, as an example, just because the pound versus the dollar, for example, is trading at just a price of 1.55, and the Aussie dollar, for example, is trading at the price 1.25, for example, that doesn't necessarily mean that the GBP is better than the Aussie. Okay, those are two different factors. So the first thing that we need to do when comparing pairs is to equalize the differences between all of those available pairings. We can do this by focusing on major pairs. For example, right now I'm going to focus on major pairs, or those pairs that have the US dollar in them. So by comparing all currencies with the US dollar in them, we can then begin to make the actual comparison of each and every one of it. Extremely simply, we can separate the strong from the weak currency by just assessing what price movement it has been made by each and every one from one and the same time period, by inputting this into a simple table, for example, with varieties of different inputs or different data that we can actually use as a very simple formula to find out in percentages how many percents in a given time period this particular currency pair has made, whether up or down. So, to equalize the differences and to find the simple way how to separate the strong from the weak is by setting the time frame and to find out the price change. Here you will see a very simple, just a normal candlestick chart for the euro-dollar pair with a 4-hour chart. I'm saying that because some of you might not be able to see exactly up here that it's Euro USD 4-hour chart. This was a screenshot I made just a few hours earlier when I was preparing this presentation. This is where the price fluctuations that I've input here, so you can largely see exactly what I mean. And when we're measuring the actual price change, you can use the crosshair and just drag it from the lowest point here on the shadow to, of course, the actual price right now. This is what we're interested in. the lowest shadow, that's the lowest point the price went, to the actual price right now, or the close of the previous session is also a very good idea to use if you don't want the price to fluctuate in the period of time when you're actually assessing this data. But given the fact that right now session, for example, could have a higher price and therefore a different result, will pretty much result in the future assessment of the strength of those currencies. Now what you can do is just get your crosshair from the lowest point of the shadow, drag it up to the actual price right now, and see exactly how many pips this particular currency has made. After you have done that for all 7 different or maybe more different currency pairs, because it's not those that I'm going to present to you today are not the only currency pairs that are connected to the US dollar. There are more, much more than that. But the only way I've limited myself to only 7 pairs is because this particular assessment is time consuming. So you can do that forever and still at the end of your analysis you will pretty much get a data that it's already passed. So you have to limit yourself to a number of currency pairs that are connected to one currency pair, in this case the US dollar, and then you will find out how strong each and every one is by categorizing them in a simple table. This table, however, looks pretty much like this. It's quite empty at the moment because we haven't really inputted any kind of data right now. So what we're going to do is, in this side here, let me just separate this so you can better visualize what I'm trying to tell you. So in the left side of this horizontal vertical line, there is one data table we will use, and on the right side where you see the grades are exactly the is exactly the table that we will be working on so far. I have a question here. One of our traders is concerned that there is no screen. I believe something went wrong during the presentation. I hope everything is right now is okay and everyone can see. Yep, there's a confirmation from another trader saying that there was no screen for the past couple of 5 minutes, but now it seems to be okay. I'm going to just slip a little bit backwards here on this chart. For those that didn't manage to actually see what I was talking about the chart, because what I've said on the previous list here is just basic guideline that you can guide yourself while I was making the presentation, but I'm pretty sure everyone actually got the point. And the most important part starts from here, where we are actually setting the time frame and the price, and we're measuring the price change. So I'm going to repeat the whole thing, and then we will move forwards. For those that didn't see the screen for more than 5 to 10 minutes. Okay, as we were saying, this is a euro-dollar 4-hour chart, ladies and gentlemen. That's for those that you cannot really see on the far top right corner what is written, because the screenshot might be a little bit smaller to your screen, depending on the size of your screen, of course. And of course, those particular prices that I've set up here were the prices that I took when I made the screenshot a couple of hours ago before I started making this presentation today. As I mentioned, the easiest way to measure the price change, as everybody already know, is by using the crosshair. But the rule of this measurement is to go from the lowest point where you want to start measuring your price change, and it's clearly obvious that the euro made a bottom here on this large shadow. So you're taking your crosshair and you drag it up to the current price to measure how many pips this particular currency pair has made in order to better assess the price change. You can, of course, use any other method measuring, but this is the fastest and most efficient way. So moving forward to that data table, as I mentioned, here you will see that we have about exactly seven currency pairs, major currency pairs with the US dollar in them. And what we will do right now is start inputting the data that we have collected so far in order to assess which currency is stronger than the other. So what you can see on your left side of this vertical line is one of the tables that we were working on, and on the right side where we are actually later on going to input those grades after we take them from this place here. Connected, everything is connected to the dollar. So you can do that with the Japanese yen, you can do that with the euro, we can do that with the Aussie, with the New Zealand, with the Swiss franc, with the Canadian, with whatever else, the South African rand if you wish, or Malaysian ringgit, or any other currency out there that is connected as a pair to any other currencies. But please remember, the base is the whole assessment should be made against one in particular currency pair, so you can find out exactly how strong they are according to this currency pair, to this currency particular. This is how you are equalizing your input, because you cannot take everything is US dollar and one of course is euro versus the GBP, for example. You cannot really assess the euro versus the pounds correctly when your base or secondary currency is different from the US dollar. So I hope you got the picture. Right now, I have prepared a few different pip sizes. Actually, those are not the actual movements of those prices, but I've taken them as a preliminary input data, so we don't spend too much time measuring 7 different currency pairs, which will be, first of all, extremely time consuming. We have a lot to talk about. First of all, the most important part is for you to see how exactly you should multiply or divide or subtract any numbers in data, that at the end you will get the place of this currency. And at the end of the whole story, we will have a look at how we can pair those to get the most efficient way of trading. Okay, I'll double click on this. You can see that this is a ready spreadsheet on this particular presentation. We can simply just input the data inside. Now, what we need here to set up right now are those pip sizes that I mentioned, gain or loss in pip size. So for the Euro USD, we'll just take, let's say, 63 pips in positive change. Here we will have about 162, for example. For the Aussie versus the dollar, we will take 131, for example. For the New Zealand dollar versus the USD, let's take 82. And here we might be able to take, for example, what we say USD versus the Swiss franc. Let's take about a negative of about 50 pips. I'll explain about later when we input this data what those numbers mean exactly. Here we will have minus 75, for example, decline in the US dollar versus the Canadian, and the US dollar versus the Japanese yen. We'll have, okay, let's take another negative of minus 12 pips. Why I'm setting up minus 12 pips? It's very important because these minuses, they mean that the pair has went down. So here on the first 4, the pair went up. On the last 3, the pair went down. So we have euro gaining versus the dollar 63 pips, the pound versus the dollar gaining 162 pips, so on and so on. And here the dollar is losing 50 pips against the Swiss franc. And right now we need to find what is the percentage change in USD, because everything is coming in a USD. it doesn't matter if it's a secondary currency or a base currency, because the price that you're actually getting is USD. So the most important part here is to find out your piece of paper or another table that you actually use to set up your current prices. So to evaluate the percentage change, you are taking the 63 pips, the price change also called, and divide it on the current price. And right now the price is 1.0980, and divide it one more time on 100 to get the percentage. And what we're getting is 0.57% change. So about 0.6% change in dollar price, the euro-dollar price. Further on, moving to the GBP versus the US dollar, we have 162 pips of price change, dividing on the current price of 1.5260 and dividing on 100% to get it. We have about 1.6% movement in GBP USD price. The actual price change, let me just get it one more time so I don't make a mistake, because the actual numbers are really important. We have 162 dividing on 1.5260, one more time dividing on 100, and we're getting 1.061%. This is what we're getting. Actually, let's limit ourselves to about two decimals after the two numbers of the decimal. And of course, it's going to get it out in a year. 1.06. For the next one, we're getting the Aussie versus the US dollar. A price, current price, okay, is 0.7655, and we have 131 pips of change to the upside of the Aussie, with dividing on a price of 0.7655, dividing one more time by 100 to get the percent, and then we have 1.71% in USD change. I just want to change this with a comma here so they are all the same. Next data input we're getting for the New Zealand dollar versus the US dollar. We have about 82 pips of change the same way, dividing on the current price, which is 0.7127. Some of you that are actually observing the charts at the moment might be getting pretty much the same numbers so far. Dividing one more time to 100 of the percent, and we're getting about 1.15% in price change. Here is the next one. We have negative 50 pips movement of the US dollar versus the Swiss franc. So we have 50 pips of negative movement, dividing on the current price change. Price is 0.9515, and one more time to the 100. So we're getting about 0.52%. Here on the USD versus the Canadian dollar is our next movement, which is about 75 pips. We're dividing on the current price, which is 1.2440, for example. One more time to divide it on 100 to get the percent. The actual number here is 0.6% of price change. Next one is the USD versus the Japanese yen. We have 12 pips of movement dividing on the current price 123.85. To the 100, we have barely moved in this particular way, so we're having about 0.01% of price change. And this is how, ladies and gentlemen, you're getting the actual percentage change according to the pip size and current price. It's not a difficult thing. You can, of course, add another column here, for example, current price, if that's something, for example, that it's actually going to help you out. And just input the data prior to your calculations. It's up to you to decide, of course, what you want to do. Personally, I would like to, for example, get the gain and loss in pips first, and then just open up my market watch on the MT4 and have a look at the current price. And of course, let's not forget the actual price that you're getting is the bid price or the sell price. That's very important for you to remember. So this is the actual data that we're going to work on. Right now we got to start placing numbers on different currency pairs. So for example, first place, second place, so on and so on, down to seventh place. The one that the currency pair that actually moved with the major percentages in terms, this is 1.7% price change we have here is for the Australian dollar. So we get first place here. Second one with 1.15%, we have the New Zealand dollar. So we have second place for the New Zealand dollar. Third place we have for the pound versus the dollar, or actually the GBP in this case. So we have third place for the pound. Fourth place, the way we're looking at those numbers, we have for the Canadian dollar. Yep, exactly. The Canadian dollar gets the fourth place. Fifth place belongs to the euro. Sixth place goes to the Swiss franc. Seventh place goes for the JPY. This is how you grade them. And over here, of course, you can just go for first place. You have first place for the Aussie. Second place we had for the New Zealand dollar. Third place was for the pound. Fourth goes for the Canadian. Fifth place for the euro. Sixth place is taken by the Swiss franc. And at the end here at the bottom, but not at the very bottom, seventh place is taken by the JPY. All right, ladies and gentlemen, what are we missing here? as we were talking about this, sorry for the tongue, but dumbass dollar, I believe in this case, after we saw that everything else is stronger here, one after another, taking a place after a place, even with 0.01%, the yen is stronger than the dollar. That means that our last place is taken by the USD. And this is how from number 1 to number 8, you have from the strongest to the weakest currency as an individual. So they're no longer pairs right now. On the right side here, you had everything in pairs. On the left side, you had everything in pairs. On the right side, however, where the grades are, we have individual currencies graded from 1 to 8. And the most important part is how to pick the right currency to trade. Well, it's quite obvious that if we already have one currency pair against another reaching its weakest point, it's better to take something that it's much stronger, and of course to compare it with something we should take something that it's less stronger and compare it to something that it's less weaker for a continuation in the move. Right now we see the Aussie standing on first place, and if we compare it to the US dollar, apparently the move up for the Aussie is close to exhaustion. However, if we take number 4 and number 5, the Canadian versus the Euro, or the Euro versus the Canadian, depends on how you have it on your platform, depends on how your broker is actually pairing those. Usually it's Euro versus the Canadian. So if you're actually going to trade the Euro versus the Canadian, that's going to take quite a bit of time for those two to shift places in order to take direction. So we might expect consolidation of those two. But for example, if we take the pound versus the Swiss franc, now that would have been a very good bet, because the pound is strong, the Swiss franc is weak, but not so weak. So we can expect the pound to move stronger against the Swiss franc further on, making us profits. Same goes for the New Zealand dollar versus the Japanese yen, or the New Zealand versus the Swiss franc, or as we move down, the GBP versus the yen. But I personally wouldn't take the first and the 8th and pair them together, because we're looking at a 4-hour chart. That data that we've taken out is from a 4-hour chart. So when we have one in oversold conditions, one in overbought conditions, of course, it's quite possible that they will start reversing, but not necessarily. So basically, your certainty falls down to 50-50% chance. The way it goes with number 4 and number 5 also goes in 50-50% chance. So to have a better bearish chance on the market, to stand a better, stand up and better make gains with higher certainty over 80%. This is a better choice to take the New Zealand versus the Euro or the Swiss franc, or the pound versus the Euro and the Swiss franc, or even the JPY. Of course, I would very much like to trade something in the middle, because it still has a direction, or as we can see, that direction is starting to develop. So this is the key importance here for you guys to remember. Not only that you're actually grading them from 1 to 8 to 10 to 20 if you wish, but you have something as a guideline of what is actually coming to an end and what is actually developing and what you can look forward. And this is, as I mentioned, this is not an actual data right now that you can use. The only actual data is the price that we're getting, a price, live price from the charts at the moment. On one of my screens I have the charts in front of me, so I'm getting my prices from the Market Watch. but some of those pairs didn't make such moves, so don't get confused by trying to trade those pairs this way. The whole thing is with educational purposes. That's why I've made different types of gains and losses here, so you can see the difference in percentages and how close sometimes they can be. You can see here 0.52% to 0.6% here to 0.57% here. So this is as close as it gets. Not to mention, but you can see the difference in pip sizes here, that the pound is actually making versus the US dollar 162 pips in the certain time frame that we've measured. But it comes on a third place instead of the Aussie that it actually made 131 pips, and it came on the first place. Of course, that really depends on the price that you're getting, and this is the price versus the US dollar. So the bottom line, when you draw the line here, this is what you have to remember. That's why when you're picking your currencies, they have to have an underlying currency which you compare it to, so you can get the actual price in whether it's US dollars at the moment, whether it's Japanese yen, furthermore, if you want to compare Euro JPY, GBP JPY, USD JPY, Canadian JPY, New Zealand JPY, so on and so forth, you will get everything in Japanese yen, and then the price change will be in yen. Then the grades will be compared to the yen. Of course, not always you will get such a low place for the currency that you are actually comparing. It's just it just happened that with the pip sizes that I actually thought of, is what happened, that the US dollar went right at the bottom. As a matter of fact, if you take data at the moment, you will pretty much get second or third place for the US dollar at the moment. This is what I got from yesterday's assessment. Today, during this, I was working on this presentation, so I didn't have the chance to grade those numbers today to see where the market is heading. But bottom line, ladies and gentlemen, this particular information is very useful on week-to-week basis. So when you look at 4-hour chart time frames, you can assess the past week and to find out what you can expect this week. So it's very easy. Just set up your period separators, measure the lowest to the highest point of a certain currency from the beginning to the end of the week. This is how you can get a precise time frame, not just look at, for example, from today noon time, for example, 12 o'clock to 4 o'clock, for example, and to measure from this 4-hour time difference for every currency pair. It's good to have it on a larger time frame, so you can do that on monthly basis, weekly basis, or yearly basis if you wish. The larger the time frame, of course, the better will align with your quarterly to half to annual fundamental assessment on any particular currency pair. And this is a wonderful way for you to pick up your best entry time. I hope I was useful to you guys with this information. If there are any questions on this topic or any other topic, as you know, this is the last webinar for this month. So I hope that all of the topics during the month were extremely useful for you. If there are any questions, just get in contact with us at webinar@gdmfx.com or directly to our telephone line through our support department. You can forward your questions, whether to me or any other account managers here, or direct personal account managers, of course. That's all for today. Thank you guys for joining us. I'll see you next month with the new topics. And of course, depending on your grades during this month, we will see whether we're going to continue with this topic one more time next month, or we will show you new trading styles and systems So until then, thank you very much for joining us. See you next time. Bye-bye.